This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 327 was recorded on June 9th, 2022. I'm Eric Townsend. This episode of MacroVoices was made possible by Respect Energy, a leading European trader of renewable energy and a one-stop shop for all green energy investors. Forest for the Trees founder Luke Gromen returns as this week's feature interview guest. We'll discuss foreign divestiture of U.S. assets, inflation, precious metals, Luke's outlook for the U.S. dollar, and much more. Then be sure to stay tuned for our post-game segment when Patrick's chart deck will be titled Summer Grind.
And I'm Patrick Ceresna. Eric, let's jump straight into that S&P 500. Obviously, after a huge couple months of volatility, it's been a very quiet week. It seems that the direction of the market has really calmed down. What's your take on all of this?
Well, the question on my mind is the calm before the storm, and I think this all hinges on whether or not inflation is really transitory and ending, as so many people are convinced that it is. If you too are convinced that it is, well, probably all is well. The bottom's probably in on the stock market. We'll probably see this eventually recover as the Fed put is there to save the day no matter what. But frankly, Patrick, I don't think that's what's going on here, and I have an evolving, what I would call a perfect storm scenario, which could make me super bearish, like worse than 2008 kind of bearish. Now, we don't have all of the dominoes lined up yet, but here's the things I see coming together. First of all, I think a recession is imminent in the United States, and I think that the Fed needs one in order to battle inflation. Now, if you think inflation was entirely transitory and over and finished with, then obviously this view doesn't make sense. But I'm not at all persuaded of that. I think that we're at the beginning of a secular inflation, which was overlaid by transitory effects, which are in fact coming out of the system now. That's causing people, I think, a false sense of hope that inflation is behind us. If secular inflation really does underlie this transitory spike, at some point it's really going to come back and bite us, and it is going to force the Fed put out of existence. Meanwhile, I'm seeing more and more analysts writing about a coming global food crisis this summer as fertilizer prices absolutely soar. Now, a lot of this is related to the Ukraine war situation, which a lot of people think is ending or almost over. I'm not convinced that it's almost over, and I'm not convinced that the soaring fertilizer price issue is over either. Meanwhile, the resumption of Chinese demand for crude oil, I think, could potentially set the stage for energy prices to explode over the summer, and stagflation could also explode as energy and food prices do not correct lower in recession. In other words, you get the combination of an energy price induced recession, where it's not recession brings energy price down, but rather increasing energy price is what brought on the recession, and you get increasing food prices at the same time. So during recession, cost of energy and cost of food goes up, not down. That's deep stagflation, and I think we could find ourselves immersed in it very suddenly and very quickly. Meanwhile, I think we have a setup come fall for Europe to be really screwed in terms of energy needs. They cannot exist without Russian gas, so far as I can tell. Promises by the Biden administration that the U.S. will supply them with all the gas they need are not based on reality. I certainly think that the Biden administration is sincere in providing as much gas as they're able to, but they're not going to be able to meet the demand. Now, politicians are not likely to let a crisis go to waste, especially not in midterm elections season, and I think the stage is very much set as all of these factors come together to blame Russia for both the things that are Russia's fault and other things that are not Russia's fault in order to avoid accountability of U.S. politicians for their own policies and their own actions. That could mean that as we're fighting inflation, the Fed put is frozen, the Fed has no ability to rescue markets, and we get into a worse than 2008 size event. I'm going to definitely ask Luke Gromen about this. I want to try to get Darius Dale back on the show. You know, he was the guy that really called this year as the potential crash year for the stock market. I want to find out if he still feels that that's going to happen and whether or not he thinks it already happened or if the crash is yet to come. So we're working on getting that scheduled later this month.
All right, well, let's move on to that dollar index because in the last week, we've seen that short-term dollar correction has really reversed. I mean, we're back above 103 on the dollar index. We'll see in the chart book when we talk about it in the postgame that the yen has legitimately broken down as the U.S. dollar yen is moving and the euro is slowly rolling over. Is the dollar ready for another leg higher? What's your take on this?
Well, as you say, Patrick, on the chart visually, if you just look at the last week or so, we're trending up again. Okay, great. I think the big moment is closing above the 5-year high at 104 spot, whatever it is. Closing above and breaking out to new highs beyond the 5-year high. That's the big decisive moment for the dollar index, and it clearly has not happened yet. I wouldn't be surprised if the consolidation that we're in continues for weeks, if not months more, before we get that breakout. But I think the breakout to the upside is eventually coming sooner or later. Until then, as long as we stay above 99, it's just a consolidation, could last a while.
All right, well, let's move on to crude oil because this is a trend that simply has not quit from last week, and we're well above 120, heading very close to 122 on the upside of crude. How did the inventories come in, and what's your take on this trend?
Well, let's start with inventory. The headline number was crude oil unexpectedly building 2 million barrels. That would normally be a bearish sign for prices. But here's the thing. That plus 2 million barrel build is really a minus 5.2 million barrel drawdown after you consider the 7.3 million barrels that were recklessly withdrawn from the Strategic Petroleum Reserve. Now, the SPR is down more than 100 million barrels in the last year as a result of the Biden administration's reckless and irresponsible use of the SPR to try to control short-term prices. Biden is canceling the flood insurance in the face of an oncoming tidal wave. And I predict, Patrick, that the day will come when we will sorely miss that extra 100 million barrels of cushion in the SPR in the context of an escalating geopolitical situation. I hope I'm wrong about that, but I'm very concerned about it. Meanwhile, Cushing, Oklahoma, drawing down another massive 1.6 million barrels. That takes us back below 25 million barrels of total stocks in Cushing. About 20 million is where most experts consider the operating minimum for Cushing. And the reason that the minimum is such a high number is because there's lots of different grades and they have to be able to blend them and mix them and so forth. Not all of the grades that are in storage in Cushing are deliverable against the WTI contract and so forth. So we're really getting low in Cushing, Oklahoma. Gasoline drawing down another 1.6 million barrels. That was the 10th weekly drawdown in a row. The one and only big build on the board, which is a bit of a mystery to me, is distillates building 2.6 million barrels. That's the best build since December of 21. This is the lowest stocks overall for this time of year ever since the data series began. And summer is just beginning. We're in a situation where summer driving season is upon us. We have not restocked, and we're in a very, very perilous situation. U.S. production, meanwhile, is flat at 11.9 million barrels. It's been there for quite a few weeks now. With the pace of consumption that we have, we're nowhere near the peak because China is not back yet. Those are the words of the UAE's energy minister, predicting a big move up in oil prices still to come. Meanwhile, we are out of spare capacity. OPEC Plus is now pumping 2.6 million barrels below its production targets. Targets? We used to call them quotas, and quietly OPEC has changed its messaging, replacing the word quota with target. It's a number we're trying to make because the world is out of spare oil production capacity. This is a really pivotal moment in world history, and most people are missing that it's happening. Now, if there's anything I've learned from trading crude oil for more than a decade, it's that when OPEC ministers make public statements on inventory day, it's almost always motivated by their desire to jawbone the market. So when OPEC ministers are saying things about we're nowhere near the peak yet, what it means is they're not trying to jawbone the market lower. They're welcoming a continuation of this move into higher prices. So I think President Biden has alienated OPEC Plus to the point that they're very much welcoming higher prices and not trying to balance the market and keep prices under control as summer driving season approaches. As far as what happens from here, I think we're headed much higher. At some point, there should be a dip as we get a U.S. recession, but I still think much higher prices are still to come.
All right, let's touch on gold. Gold's been just trading sideways for the last 2 weeks. We were 1850, almost like a deja vu of last week. What's the next move for gold?
You know, Patrick, I feel like Scrooge, except I just want to say bah, gold bug. The price of gold has basically just languished here. It's hanging out in between its 21 and 34-day moving averages. Seems to be the little triangle pattern that's formed over the last week or so. We need to see a breakout above that 21-day moving average, back above 1860 or so, in order to maybe show us that this rally can continue. But frankly, I think all the fundamentals are in place for gold to be $500 higher, and they're not. Now, you'll hear an opposite view from Luke Gromen in today's interview.
All right, and let's just wrap up with touching on the 10-year Treasury yield, which is back above 3%. Do you think that means anything?
Well, Patrick, as I've said for many weeks on MacroVoices, get your popcorn out when the 10-year goes above 3%, and it has, of course, moved back above 3% as we speak on Thursday. So I'm going to introduce what I've been calling my inflation dipsy-doodle hypothesis. And what I mean by that is clearly there is a component of inflation which is transitory and has been caused by supply chain disruptions which were induced by the pandemic. Those are starting to correct themselves. They will come out of the system. That inflation effect will, in fact, be transitory. Now, what almost everybody is assuming is that that accounted for all of the inflation that we've been seeing, and since it was transitory, it's going to be going out of the system and everything's going to be fine. Just give it a couple more months. I don't think so. I think what's really going on here is that a new secular inflation trend underlies those transitory spike effects. And what we're going to see is inflation comes off for a while. Everybody decides it must have been a false alarm. It's not really going to hurt us. Everything's going to be fine. And then it comes back with a vengeance when we realize, oh my gosh, there really was a secular trend there. And although there were effects that were transitory and related to the pandemic, the underlying trend is much stronger and it's structural and it's probably going to last for the rest of the decade. Now, I could be wrong about that. I don't have any way of proving it. But if it turns out that I'm right, it really is going to set up a very, very difficult time for the economy, for bond yields, and so forth. So why am I bringing up this inflation view now? Well, because the 10-year yield is one of the best indicators we have to tell us when the timing is right for the world to wake up and say, oh, wait a minute, inflation wasn't really transitory after all. Is that happening already? Is that why we're back above 3%? Or are we only going to be above 3% for a day or two and then back down? We'll see what happens. But if we have a sustained move above 3%, I think it potentially means that we're realizing inflation wasn't transitory after all, and that could set the stage for a whole bunch of stuff to go very, very seriously wrong. So I think the 10-year yield is the most important diagnostic signal to watch to alert us when the shit really starts to hit the fan, a subject that I'm going to discuss with Luke Gromen in today's interview.
Well, this week's feature interview guest is Forest for the Trees founder, Luke Gromen. Now, Eric, why did we get Luke back on the show this week?
Patrick, for years now, Luke has been telling us about his theory for why the U.S. dollar will eventually decline dramatically as it loses its hegemony over the global financial system and falls out of reserve currency status. I've always agreed with that view in the very long term. I just thought Luke was maybe a little bit early. I kind of thought that Brent Johnson's view of dollar up first would be proven out first, and then Luke's view of dollar down hard would happen 5 or 6 years later. I wanted to get an update from Luke as to what he sees. Is this the moment where Brent's about to be proven wrong and the dollar is going to drop like a rock? Or do we see a brief period where the dollar moves against Luke's long-term bearish view, a little bit more in accordance with what Brent Johnson had predicted? So I wanted to get an update from Luke on what he sees, and of course to also talk about current markets and what his outlook is.
Well, Eric's interview with Luke Gromen is coming up as Macro Voices continues right after this message from our sponsor.
If you invest to bring about a world powered by green energy, you should meet Respect Energy, a leading European trader of renewable energy that serves as a one-stop shop for green energy investors in Europe. Respect Energy brings together independent power producers, accredited and institutional investors holding assets in renewables, or undertaking investments in new green energy production, such as wind and solar photovoltaic power plants. More than 600 institutional and accredited investors have already entrusted Respect Energy with the sale of their electricity production, portfolio management, O&M services, EPC, and project development. If you want to invest in green energy in Europe with the help of a trusted partner, contact Respect Energy today and ask for a tailor-made solution. For more information, visit respect.energy.
And now, with this week's special guest, here's hedge fund manager Eric Townsend.
Joining me now is Forest for the Trees founder Luke Gromen. Luke, I've really been looking forward to this interview. You know, it's been fascinating to me since that Fed survey came out saying that an unprecedented 41% of respondents had become concerned about foreign divestiture of U.S. assets. I've had just wildly opposing views. David Rosenberg told me just fade that entire report. There's nothing to worry about. That's, just don't even think about that being an issue. Whereas Louis Gav seemed to think it was a huge issue. And I know that you've probably out-Louis Gav'd Louis Gav, because I heard you say in another interview that you thought it was on par with the Nixon moment on August 15th of 1971 when President Nixon effectively defaulted on the Bretton Woods Agreement. So talk about what's going on here with the seizure of Russian FX reserves and also the extrajudicial seizure of other Russian-owned assets in the United States. Is this a big deal? Why is it a big deal? And why aren't many people other than crazy nutcases like you and me taking this seriously?
Crazy nutcases indeed, right? No, thanks for having me back on, Eric. I think it's a really big deal simply because the U.S. has a supply-demand problem for treasuries. And when you have a supply-demand problem, you are trying to make your assets more attractive, not less attractive. And so, to me, I just think it's a big moment because it had never been done. I mean, it had been done to some smaller countries, but it had never been done to a G8 nation. It had never been done to a nation on the UN Security Council. It had never been done to the world's biggest producer of commodities, to the world's biggest exporter of energy. And I think we're seeing that it is a big deal in markets. And by that, I think we can just look at the ruble dollar rate doing what it has done since those sanctions were announced. I mean, we saw the ruble go to whatever it was, 120 against the dollar, and President Biden pronounced it dead and buried, called it rubble, and but that was sort of declaring victory at the end of the first quarter, and the second quarter of the game featured Russia coming out and effectively defending the ruble with gas, and people say, well, the ruble's a one-way market. The ruble, I can't buy and trade rubles. Well, the U.S. made it a one-way market, sell side only, when they put on the sanctions, right? So you sort of can't have that argument both ways. So the U.S. made it sell side only one way, and Russia came out and said, that's fine. we're going to defend it by saying you got to have it to buy gas. And so there's sort of this bifurcated reality where, paper FX traders can't buy rubles, or the spread's not what, the number's not what they see on their screen. And I think that's right. I think I sympathize with that. But the real market, I think that the paper FX market for rubles is a sideshow. The real game is Europe buys $150 billion a year of energy from Russia. And once the U.S. did what it did, sanctioning FX reserves and trying to trigger a collapse in the ruble, it forced Russia to defend the ruble. And Russia really only has one thing to defend it with, and it's energy. And so they defended the ruble with energy because of what was done to the FX reserves. And we've seen what the ruble has done since. It's trading at 60 today. It's up against the dollar pretty notably on the year. It's the best performing currency in the world on the year. And it's really, it's a two-way market. If you need gas, you're buying rubles. If you don't need gas, it's still a one-way market, but they don't care. They're trying to defend their currency. So I think when you look at what has happened in the markets as it relates to that, I think that all goes back to this sanction of FX reserves and the implications of that for others, which is now that weapon has been deployed, everybody else is going to. I mean, this is warfare. This is just economic warfare. And so once your enemy or your adversary deploys a weapon, you immediately, if you are smart, if you have a brain in your head, you immediately go about looking to disarm or protect yourself from that weapon. And how do you do that? You stop. At the very least, you stop growing your holdings of treasuries, at the very least. And you look for other alternatives. Clearly, I don't disagree with the point that there are not many other sovereign debt markets there are no other sovereign markets that are as deep and liquid as a treasury market. Of course, treasury markets had its own liquidity problems in recent years. It's only been deep and liquid at key times or any time there's been stress because the Fed's been in there injecting liquidity, which is not exactly a great reserve asset characteristic anyway. So to me, I think what we're seeing in ruble, gas, energy, geopolitics suggests it was a very big deal. And I think the ultimate outcome is kind of what I led off with, which is the U.S. has a structural deficit problem. It needs more buyers of treasuries rather than less, preferably at negative real rates. Actually, it has to be at negative real rates with our debt levels as high and our deficit levels as high. And the U.S. is out there advertising, hey, these aren't safe. We will take them if you are a bad actor. And the reality is Russia's a bad actor, but Japan was a bad actor in the 80s. The Germans were bad actors. At one point, the French were bad actors. The Israelis were bad actors. The Saudis were bad actors 3 years ago. So there's, who's a bad actor and who's not shifts a lot. And so I think it's just going to touch off, I think, a sort of a slow, steady, relentless bid for physical gold as a reserve asset or a redeployment of surpluses into productive things, right? So instead of the Saudis storing any excess surpluses in treasuries, they'll store them in developing their own country or developing elsewhere, or paying Dustin Johnson $1 gazillion to go golfing, whatever they want to do. But the bottom line is any dollar, any surplus that is diverted away from the treasury market increases the pressure on the Fed to ultimately finance U.S. deficits because they're the only one with a big enough balance sheet to do it without crowding out the domestic and the global economy.
Luke, I happen to agree emphatically with everything you just said, but in the interest of good journalism, I'm going to play devil's advocate here and say, wait a minute. A lot of people would say, look, the situation with Russia was a sanctions issue. There is no sane reason for anyone to think that the U.S. can't afford to pay its bills or has to default on its debt because it's insolvent or anything like that. The reason that Russia's foreign exchange reserves were seized was because of Russia's aggression in Ukraine. And people might say it's not completely unprecedented in the sense that after Pearl Harbor, Japanese assets, I don't know about Japanese FX reserves. I'm not that good of a monetary historian, but certainly a lot of Japanese-owned financial assets in the United States were frozen after Pearl Harbor, so it's not unprecedented. And I guess to my thinking, Luke, if I had to try to make the counter argument here, the big counter argument would say, look, Luke, if what you're saying was true, the price of gold would have doubled by now, because if we saw other people losing faith in the U.S. dollar as a reserve asset because they're afraid that what happened to Russia might happen to them, they would be divesting U.S. treasuries, which is certainly reflected to some extent by the upward pressure we've seen in yields, and they'd be reinvesting in gold or some other reserve asset. And gold hasn't budged. So how could that possibly be true?
Ultimately, you can only watch the flows of gold, and you can see, was it the Czech central bank came out last week and said we're going to increase our gold holdings, 10x over the next several years, from 10 tons to 100 tons. You could see, the Indian central bank buying more gold. You can see the flows, the price. Ultimately, what we've said in the past is none of this is going to matter for the price of gold till it matters for the price of gold. The only thing that you can conceive of is the amount of paper derivatives on gold, unallocated paper derivatives, is expanding faster than demand in theory, or it simply hasn't really begun in earnest yet. It being the shifting from treasuries to gold. Because when you look at the inventories at, say, COMEX of gold, a small hedge fund could go in there and create a Hunt Brothers short squeeze, right? So the reason they haven't, everybody likes to make more money. So if there's only a little bit of inventory at COMEX relative to the amount of dollars out there, and nobody has done it, either we have to believe everybody in the world with more than, a couple $100 million in assets doesn't want the free money implied by creating a Hunt Brothers short squeeze in the COMEX gold market, or there's a political reason that they have been told not to try that, or someone has tried it and has been told not to try it. Who knows? But at the end of the day, for me, it's less about, hey, gold hasn't doubled, so it's not positive for gold, and more about just a structural, long-term, secular, positive bid for gold as a reserve asset over time. I will say, and I think this is probably what I should have led with, which is if you look at what U.S. rates have done and you look at what gold has done, gold should be $400 or $500 lower than where it is today. It hasn't budged. So I would say, I think part of why gold hasn't moved is less some of the paper derivative stuff, which is always something you have to consider as a gold investor, all that. And I think it's more that there is still tremendous credibility that the United States is going to raise interest rates and tighten policy and induce a recession. And I think the fact that gold is $1,850 today and not, where it should be on real rates, which is $1,450 or $1,300, I think is an early sign of exactly what we, big picture, exactly what we described, but more importantly, more acutely, I think there's a lot of people that I think the gold market is calling BS on the U.S.'s ability to raise rates and to tighten policy in any real way, in any real sustained way.
Let's come back to Russia defending its currency through energy. It seems to me like, at this time of year, Europe can get through the summer without needing Russian gas nearly as much as they do for heating in the wintertime. So does that set up a tradable situation that's coming up in the fall where we potentially get Europe being forced to go back to buying Russian energy, which Russia might continue to demand rubles for? Does that strengthen the ruble even further, or does that trade break down at some point?
I think the ruble is going to keep going up. I don't know whether it's tradable or not, particularly to people in the West, either due to shadow or self banning or actual outright sanctioning of Westerners trading that. I think the ruble is going to keep going up because of what that describes. I think the tradable aspect of it is probably short in the euro. I watch what the Eurozone's doing. I think it was Louis Gabb who had the phrase, "Is the Americans are willing to fight the Russians down to the last European." And as harsh as that is, and as tongue in cheek as it is, I'm waiting for European leadership to sort of wake up, because I watch what Europe is doing. you've got this debt level that is completely unsustainable. You have followed policies at the encouragement of the Americans to start cutting out your energy inflows, your energy supplies. And the only way you can afford to pay that debt is with more cheap energy, not less cheap energy. Really, what we've been highlighting for several months is that the Europeans are going down a path, the same path, or directionally the same path that Weimar Germany went after World War I, which was Weimar Germany owed a bunch of debt, and then the French showed up in the Ruhr Valley and seized the coal reserves, seized energy, reduced energy into the German economy as a war reparation, and the Germans made up the difference by printing the money. And we all know what happened then, famously, and it's not apples to apples purely, but directionally, we have a situation where European debt's unsustainable, wildly unsustainable, and now they voluntarily are getting rid of their energy, which is sending production, PPI, right? I mean, I saw it the other day. German PPI is running, I think, 30%. The German Bund is like 60 basis points, right? So, like, there is no planet that the ECB can raise rates high enough to reduce energy input inflation without blowing up the debt when they're cutting back their energy inputs from the Russians. And so what's the response? You see it in the UK. Well, we're going to start handing out 400 pounds to everybody because energy costs have gone up. Are you insane? Like, they are literally in Europe and UK setting up an energy hyperinflation death spiral with their currencies, which, if I'm looking at it from a very Machiavellian way, there's, I think, probably certain interests in Washington that would love to see that happen. Watch the Eurozone implode. Get those German surpluses recycled back into buying treasuries instead of financing, Southern European deficits. But I think the tradable trade here, as we get towards the fall, I think the base case is I think there's two outcomes. I think the first outcome is Europe sticks to their guns, energy inflation goes nuts, and or their economy collapses, their ability to service their debt collapses, and then either that entire market and economy collapse chaotically, which will bid the dollar and U.S. treasuries for like a cup of coffee, and then it will collapse U.S. markets and U.S. economy as well. Or we get to the fall and it starts getting cold at night, and Europe goes, sorry, USA, we're done. We can't do this. We can't let people freeze here. We're going with the Russians. And the Japanese go, hey, America, the yen's at 132. It keeps rising. Our energy costs keep rising. We got to call the Russians. We got to ask them for gas in yen. Sorry, we're leaving you too. And so I think as we go to this fall, what's the tradable possible options are either basically an economic or inflationary, the euro collapsing against the dollar, or a massive reordering of the post-war security order as we have all come to know it, which is to say the Europeans and the Japanese say, sorry, America, we need gas. We need people to not freeze to death more than we need, protection from you or the relationship as it's been structured. And I don't know how that is tradable. I think if that happened, that's probably dollar negative, I would think. But I don't fully know I haven't fully thought about the implications of that from a market standpoint. But that's how I'm thinking about it at this point.
Luke, French President Emmanuel Macron seems to be the odd man out in Europe, where everybody else is banging their fists on the table saying, Russia, bad guys. Macron seems to be the one saying, wait a minute, let's think about what we can afford to do in terms of alienating Russia. Let's think twice before we burn any bridges. Is that just because Macron has a different philosophy than other leaders, or is there something about French economics that make France more vulnerable to this energy situation with Russia than other countries?
And I don't know all of the specifics about who's taken. I thought the Germans were most susceptible in terms of percentage of energy inputs. I thought the French still had a bunch of nuke plants that were running that might make them better off, but I might be misspeaking. So I don't know for sure. I don't know if that is tied to, historic French desire to maybe a little more animosity towards the Americans than the Germans, say, historically, within the European Union. I don't know if it's that, or if there are commercial interests, or if it's energy. I don't really know. Maybe he's just actually being pragmatic, as opposed to the others in Europe that are pretending like it's not going to get cold and that they don't need the gas, which is like believing in maybe skittle shitting unicorns are going to deliver the gas to them. I don't know.
That actually sounds more likely to me than the other option, which is President Biden already promised to deliver to Europe as much gas as they need, using non-existent export terminals to fill up non-existent LNG transport ships in order to supply the gas. In any event, let's move on, Luke. You and I have talked quite a bit in past interviews about your view that over a longer time period, the U.S. dollar, for a lot of the reasons we're talking about, the loss of confidence of other nations in the dollar as a reserve asset, that would cause the dollar to decline dramatically. Yet, in the tactical time frame, you just said a moment ago that it's very likely that the euro could collapse against the dollar, which means dollar up substantially. So I think these are actually compatible views, but help our listeners reconcile that apparent contradiction.
Yeah, I think it's ultimately just an order of sequencing and the pace of that sequencing, where if the euro collapses against the dollar's going to skyrocket. You'll see a flight to safety in the dollar. I think you'll also see, as the dollar rises, you'll see, treasuries selling around the world to raise dollars, global dollar assets selling to raise dollars. So you're talking about a scenario where two things are going to go up. Oil and gas, as one, are going to go up, and the dollar is going to go up. So the dollar is going to rise against everything except oil and gas. And the dollar is going to crash against oil and gas in that scenario, in my view. And that then leads to a scenario where, as oil and gas go up, Russia gets stronger, and as the dollar goes up, America gets weaker. Because as the dollar goes up, U.S. corporate profits decline, layoffs go up, U.S. deficits go up, U.S. tax receipts go down. And that math will happen. I think the U.S. is betting that at some point on the dollar, oil and gas will fall and they will come out ahead, and they can use the dollar to once again as a blunt weapon to beat the world into submission, including the Russians. And then Americans can buy up the world on the cheap, and we restart the whole cycle, etc. I don't think that's how it's going to go. I think energy prices, as the dollar goes up and the U.S. economy declines, you're in a sort of stagflationary environment here in the U.S. U.S. goes into recession. You're going to, this already, we're going to go back to the point I made at the start, which is the Fed has never begun tightening with U.S. debt to GDP at 120% and U.S. deficits at 6 to 7% of GDP. It's never happened, not in at least 80 years. So anyone sort of, applying the framework of the Treasury market and U.S. markets and the dollar of the last 40 years, I would take that framework and I would throw it in the trash bin, because the reality is the Fed has never tightened with debt this high and with deficits this high as a percent of GDP. And what that means in plain English is that as that recession happens, as oil and gas spike and as the global economy tanks and as the dollar strengthens and the U.S. goes into recession, U.S. Treasury yields are going to rise, not fall. And so there's no playbook anybody has seen where U.S. goes into a vicious recession and U.S. interest rates go up. And again, that then goes back to, okay, well, we got oil and gas up, we got dollar up, and we've got rates going up. Who's got the better balance sheet, Russia or the United States? Who can better weather a rise in interest rates? Well, Russia's rates are at 11 right now, down from 20, and they're fine. U.S. couldn't afford 11. U.S. can't afford. I mean, we're seeing it right now. Target's numbers this morning. U.S. can't afford. Where are we at? 75 basis points, 100 basis points on Fed funds? I don't even know where we are. So it really is a balance sheet contest between the U.S. and Russia at that point, and I think Russia wins. So that's, I think, when you marry those two up, absolutely, I think in the short run, it's very bullish for the dollar. to the point only that it becomes apparent to markets that the U.S. has a balance of payments problem, which is what U.S. recession, but rates up, is telling you. And I think basically the moment you see U.S. go into a recession due to the factors we just laid out, and they see Treasury yields start to go up, I think it's going to be a dinner bell for people to sell the dollar, to buy gold, buy Bitcoin, buy more commodities, buy more inflation hedges, because once you see the U.S. go into a recession and Treasury yields going up because of the balance of payments problem I just laid out, that is a message to those with the eyes to see it that one of two things is going to happen. The global economy, the U.S. dollar system, is going to go into a death spiral, which is, Brent Johnson's, hey, the dollar goes to 200, DXY goes to 200, and the world collapses. I don't know that'll happen, but it could if the Fed just stands aside. The more likely outcome, and why I think it is, dollar negative, is much more likely is the Fed comes in with some version of yield curve control and actually prints money to contain U.S. Treasury yields in a recession, and the balance sheet goes vertical instead of the DXY. The Fed's balance sheet goes vertical instead of the DXY. And as that happens, I think the dollar goes down probably a lot. So that's I think, how I would rectify that tactical and path relative to the sort of how it ends up in the end.
I want to go back to your comments about stagflation, something that's really surprised me. We get a lot of really smart guests on MacroVoices. And with the exception of Ronnie Sterfeli last week, who's a gold guy, it's not surprising that he's on a stagflation-focused message. Just about everybody else I talk to is telling me, look, the inflation spike that we saw was a result of the pandemic and supply chains. It's already peaked. The peak is behind us. We're headed back down to 2% inflation. And I don't agree with that at all, but I'm shocked by how consistent that view is. What's your take, Luke? Is it true that the inflation that we've seen was entirely about the pandemic, or could this be the beginning of a secular inflation, which is my thought?
I think it's absolutely a beginning of a secular inflation. Whether, you want to, now, within that, are we in a deflationary cup of coffee for time period for, stuff you buy at Target? Probably. For used cars, maybe, probably. For oil, no. Gas, no. Food, no. Secularly, though, you can't get online or just go somewhere without saying, hey, deglobalization, or we're going to reshore. If globalization was disinflationary for 20, 30, 40 years, it strains credulity to think that deglobalization and reshoring won't be secularly inflationary. So I think that's point one, that secularly, I think that's enormously inflationary. And I think that's something that's going to happen in part based on what we've seen. But I also think it completely ignores what happened here, which was we had a government transfer payment bubble that, as a result of the backside of COVID, right, getting sort of trying to drive a recovery. And I think you have to go back to, again, the U.S. balance sheet. The U.S. government cannot repay its debt without inflation. Full stop. They need negative real rates. When you have debt to GDP at 120% and you're a twin deficit nation, if you do not have negative real rates, you will mathematically default. It's like third grade math. And so this is the elephant in the room that I think everybody's saying that, hey, we're going to go back to 2% inflation. We better not. We go back to 2% inflation, U.S. real rates go positive. That is your implied bet is that the United States government is going to default. In my opinion, there's zero chance of that happening. So, are we in a brief period in time where stuff at Target goes down in price because their inventories were up 43% and their demand is falling? Yeah, maybe, probably. Is it negative for oil and gas? No. Or, do I think we're going to have deflation in oil and gas in any real way? Probably not. And I think the real bottleneck in all of this is the dollar is the reserve currency of the system. We are the center of the system, and our balance sheet, we literally cannot afford our debt unless U.S. real rates are negative. U.S. real rates negative implies sustained inflation. And so, and that's, I think, ties back to the point I made before earlier as well about why gold hasn't risen. Why hasn't gold risen more? Well, it's done really well given what rates have done. But there's, to your point, Eric, there's still this widespread consensus view that inflation is going to return to normal. The U.S. balance sheet tells you there's like zero chance that's going to happen. That inflation is going to return to some normal pre-COVID level. It better not, because inflation returning to some pre-COVID level on a sustained basis implies the U.S. government defaults on its debt. And I think there's zero chance that's happening. So I just think we're in a period of time right now between sort of two trapezes, right? We've let go of the 2020 through mid-2021 of, hey, we've got fiscal stimulus on top of fiscal stimulus on top of fiscal stimulus, and the Fed's monetizing the whole darn thing. And, we've sort of let go of that trapeze after, policymakers had the crap scared out of them by how bad inflation got. And now we're in sort of this, well, they're just going to stop inflating and they're going to tighten, they're going to renormalize, and we're all going to go back to normal. There's, in my opinion, virtually zero chance of that happening because of the balance sheet of the United States. That Rubicon has been crossed. The United States debt to GDP is 120%. The deficit is 6 to 7% of GDP. We are, as a nation, with record tax receipts, like off the charts record tax receipts. The United States still cannot afford its treasury spending, its entitlement pay-goes, or its defense spending altogether with record tax receipts. And so, unless they're willing to step up and slash one of those three things massively, let alone everything else they spend money on, the balance sheet of the United States is our leading indicator, and it tells you we are going to get inflation for a long time to come. And I don't know when we catch the next trapeze. I think the slowdown we are seeing, this rapid slowdown we're seeing in the U.S. economy as we speak, I think is a sign that the next trapeze is coming towards us. And what does that look like? That looks like, 2 months ahead of a midterm with the U.S. heading toward recession. Hey guys, $10,000 debt forgiveness, student loan forgiveness for everybody. There's a huge chunk of fiscal right there. But the bottom line is the leading indicator is the U.S. government's balance sheet. They need that 120% debt to GDP to get back towards 70 or 80% of GDP before the Fed can normalize policy without blowing up markets, without blowing up the U.S. and global economy. And just by way of context, the 8% CPI inflation we saw in 2021 took it from 129% of GDP to 122% of GDP. So we need double-digit inflation for probably 5 years. And if we don't, then you're going to see what we've seen year to date, which is stocks down, bonds down, and wash, rinse, repeat until either you have a systemic collapse or the Fed is forced to come back in to finance U.S. deficits.
It sounds like our views are extremely compatible, Luke. I'd like to introduce my own thoughts on inflation and get your feedback. I've been calling this, or I'm starting to call this, an inflation dipsy doodle. What I see is, of course, the inflation that we've just seen, there was a transitory effect from the pandemic supply chain interruptions that exacerbated the beginning of what I think is a secular inflation. Well, those transitory forces are coming out of the system now, and that's why we've seen a peak, and that's why almost everybody, except you and I, are saying, okay, look, that inflation thing was just a scare. It's behind us, never to be seen again. So I think that inflation continues to come off for a little while until it starts to come back in, probably led by energy prices. And then I think the next point where maybe there's still another round of people staying in denial is we get to even higher inflation than what we saw at the peak a month or two ago. But everybody says, okay, look, that's just because of that stinking Vladimir Putin. It's all his fault. And it's because of what he's doing in Ukraine and how that's affecting energy prices. But that'll be transitory too. And there will be transitory too. At some point, we'll get some resolution to the Ukraine war, and inflation will come off a little bit, except it won't go all the way back down to 2%. It probably won't get back down to 5%. And then it goes up and it makes a new high. And I think at some point you get this, oh my gosh moment where it's like, oh, it really is a secular inflation that started around the pandemic bottom. And we've just been kidding ourselves with all of these excuses we're making about why it's transitory, when in reality, those are just exacerbating factors that are ignoring a much more important underlying base trend. How does that jibe with your thinking?
I think it makes a lot of sense. I think some of it will definitely be energy driven or energy exacerbated, because one of the great underappreciated factors in the inflation debate that's been going on, in my view, has been this fact, which is it's been almost 4 months now since Putin invaded Ukraine. And we saw oil prices rise, whatever they rose. I guess they're up probably, 35, 40, 50%. And consensus overwhelmingly at the time was, don't worry, America will step up and we'll increase energy production. Shale will come through. Last time I checked a couple of weeks ago, U.S. shale production was up 100,000. U.S. total oil production was up 100,000 barrels a day. 100,000 barrels a day. And when I talk to people in the energy patch, it ain't coming. It's you are, for a whole number of reasons, you've drilled and fracked a lot of your A and B locations. You're left with C locations, so productivity is declining or non-existent. You've got inflation and supply chain problems in all sorts of energy-related industrial goods, et cetera. You've got employment problems because when you laid a bunch of guys off 2 years ago, it wasn't like they were sitting around the phone waiting for a callback. And so you've lost a massive amount of your skilled labor. That introduces further inefficiencies. So I think the message, there's a message that's been greatly underappreciated. And really, let me add even to that. China basically shut down for several of the last months, or for a couple of last months. And so you've got a situation where China has been shut down to a significant amount, and oil didn't drop. And oil ran up, and U.S. shale didn't respond. And so I think one of the sort of still wildly underappreciated dynamics is this peak cheap energy view, which is something we've been writing a lot about, which is just that, like, the marginal barrel of oil, what's it cost? What's the marginal oil barrel cost? Well, what's the price today? There's your marginal barrel. So it's not 40 or 60 or 70. It's 120. And to really grow production, what the last 4 months have taught us is to really grow oil production, probably 150. Who knows? But it's an expensive number that is going to add to inflation at a time when the U.S. balance sheet is in a position where, look, the Fed can pretend they're going to tighten, but they can't structurally. The United States government cannot afford positive real rates. They need negative real rates, which means they need inflation well above their interest rate, or else they will default on their obligations. And so I think between this dynamic, and I think there'll be an interplay. I think we're seeing it a little bit now, but I think there will be a sustained interplay between this dynamic of the U.S. must have significantly negative real rates on a sustained basis to afford its debt, just to keep the wheels on the cart, and this peak cheap energy dynamic, which is prices are going up and no one can produce more oil, in part because, oh, by the way, the big four shale basins are declining at existing production is declining at a 5% per month rate. So just to stay flat, you got to grow production 60% a year. I think those two are going to interplay back and forth to each other. And I just get the sense that there's a lot of bond bulls out there that just they're not looking at either one of these two, which I think are, forget elephants in the corner. I think they're two King Kongs in the corner as a bond investor that I just think are going to sort of, reverberate back and forth and drive secular inflation, I think, much higher over the next 3 to 5 years than most people believe is possible at the moment.
Let's go a little deeper on your comments about the U.S. having to have deeply negative interest rates in order not to default, which you described as just third-grade math. It ought to be obvious. I'm quite certain that the Congress of the United States and the White House don't understand this. So I don't know if that means it's above third grade or if they're below third grade, but I'm sure that they don't get it. So let's go a little deeper, because when you say they would be forced to default, look, the U.S. can print money in order to not default. Now, you can certainly make the argument that that ought to be inflationary and ought to lead to inflation, but they don't have to have the inflation in order to push the button, print the money, and pay off the next Treasury payment. So why do you say that they have to have deeply negative interest rates in order not to default on their debt?
Well, you can just see it what's happened here, right? So the punchline is that up until just recently, the U.S. tax receipts, total tax receipts, were not covering just the just the Treasury spending, right, which is interest and other things Treasury is spending on. Entitlement pay goes. So with tax receipts at a record, 4.3 trillion maybe. Last year, the U.S. entitlement pay goes, just what they wrote out in checks to pay entitlements to keep those entitlement obligations money good, right, to pay out what they're owed. They paid 2.8 trillion. So nearly 70% of tax receipts alone are going to entitlement pay goes, which is health and human services, Social Security. And then defense, which is 850 billion, probably not going down now that we're in this thing with this proxy war with Russia, and writing money to checks to Ukraine like it's going out of style. So you're those three alone: Treasury spending, entitlement pay goes, defense, with tax receipts really in a bubble. If you look at the chart, it's incredible, up enormously year over year. With the tax receipt bubble, the U.S. was able to get to 100% of their big three expenditures. Then they have to borrow the money for everything else. And the issue then is the tax receipts, if you look at them, they've been very tied to asset prices. So when asset prices, and in particular when stocks fall, tax receipts fall, and just on a slight lag. And so now, year to date, we've seen stocks fall, bonds fall, crypto fall, home prices are maybe flattening out. We'll see. At any rate, the point is that tax receipts are going to start dropping year over year alongside asset prices, probably within the next few months. But entitlement payments are not going to drop. Treasury spending is not going to drop. In fact, it's going to go up because interest rates are going up. Defense is not going to drop because the aforementioned proxy war with Russia. So you're going to get into a rising deficit scenario. And if we have a recession, the last two recessions, U.S. deficit as a percent of GDP rose by 500 to 800 basis points. So you're looking of, trillion to $1.6 trillion more in Treasury issuance. Who's the buyer? With the dollar going up, foreigners are sellers on net, and certainly not buying anywhere needed enough. Fed's selling, allegedly, right? Everybody believes Fed's going to tighten away for the next couple years, which is, I think, wrong. But Fed's selling, Treasury's selling. They'll sell more as asset prices fall because receipts will fall, so their expenses won't fall, so issuance will go up. So Treasury's selling, Fed's selling, foreigners selling because of the strong dollar. Who's a buyer? And the answer, of course, is, well, there's always a buyer at the right price. Exactly. So now rates are going to go up to find where that is because private sector balance sheets aren't big enough to finance that number. By the way, they have to sell other assets to raise the capital to buy those treasuries. So what do they sell? They sell stocks. What do they sell? Other assets. Asset prices down, tax receipts down, treasury issuance up. Oops, we have to upsize the auction. Oops, we have to. So you get into this death spiral where, again, when I say the U.S. would default, that is the ultimate end game if the Fed just stands aside. The reality of it is that way before that, to your point, the Fed can print money. And they will. They'll come in and they will print the difference. We've seen it repeatedly over and over. But what it speaks to is, again, people just aren't considering the U.S. balance sheet because for 40 years, anyone in this business that is under, 65, 70 years old has never had to think about the U.S. balance sheet. Never had to. But if you look at the U.S. balance sheet, it looks like the balance sheet of an emerging market, except it issues the reserve currency and can print money whenever it wants. So that, I think, is really where I shake out on it. Why I think it's secularly inflationary is there is the U.S. balance sheet is where it is. They need to get that debt to be able to get out of this predicament. You have to have inflation run higher than your interest coupon for an extended period of time. Once you get that the GDP back down to 70, 80%, then you can tighten rates and it doesn't trigger this dynamic of, oops, we're not covering, tax receipts aren't covering just our big three. By way of comparison, in 2016, the big three peaked at I think 130% of tax receipts, and that's when the Fed was monetizing the whole thing, the entire deficit, a year and a half ago. In 2016, the big three were like 62% of tax receipts. Just to give you an idea, in 6 years, how much these things have consumed of receipts. And so it's really along that line of you've got to get nominal GDP high enough to get the debt to GDP low enough so that when you tighten, you don't trigger this shortfall in receipts relative to expenditures that either drives interest rates up. You basically have the free market setting interest rates for a government that owes a lot of money. That's not good. Or the Fed caps rates by growing their balance sheet, or keeps rates at politically expedient levels by growing their balance sheet. So that's why, do I think the U.S. government's going to default? No. If the Fed stood aside today and did nothing, would the U.S. government default? Yeah. Would a lot of others default before? Sure. I don't know if that's any, I don't know if that's any consolation, because, when Brent talks about it, I think he thinks that that's a 6, 12, 18-month time horizon. It's like 6, 12, 18-day time horizon, maybe hour time horizon. So, that's I think part of the difference in our views on it. But at any rate, I'll pause there because I probably overshared.
Luke, you alluded earlier to the possibility of a recession coming in which interest rates actually go up, not down. A somewhat unprecedented scenario. I'm going to one-up you with that and say, not only do I think that is possible, but I think you could see inflation continue to rise during a recession, as much as that's seemingly impossible. I'm convinced that the current political administration would probably respond to a recession by doing things like forgiving student debt, trying to help, and that's going to, as you said earlier, exacerbate inflation. But particularly, I think almost everybody is assuming if you had a U.S. recession, then oil prices would collapse in half. I don't think that's true at all. I think that they would dip briefly, but they would then continue to rise. If we saw an inflationary recession, which is punctuated by higher interest rates and higher energy costs and higher gasoline prices. First part of the question is, would you agree with me that that is entirely possible in this environment? And if so, what are the knock-on effects? Because, if you're talking about that situation, it's going to require a major political upset. It potentially is the kind of thing that, gets presidents impeached and replaced and so forth. What happens next if we get to that scenario?
Yes, I agree it's possible. I think it's probably likely, actually. And what happens next, I think you actually get gold to move, for starters, because I think everybody that thinks we're, going to go back to some sort of pre-COVID inflation thing is going to go, oh, God, I need to own gold. And that's a lot of money. So I think it does I think that does well. I think Bitcoin rips, et cetera. I think the implications of it politically, yeah, it's not good. I think we'll get into a whole bunch of propaganda. This is, I think they'll tell us inflation is 7 and it's really 14 or something, which I think they're kind of already doing. It's challenging, and it'll be very challenging in emerging markets in particular. So it's really the Fed's worst case scenario, where you're going to have bonds going down. You're going to have inflation up well above yields, and you're going to have, basically, they're going to have to be monetizing or growing their balance sheet into that just to maintain the solvency of the government. I mean, the overriding bottom line is the balance sheet of the United States government post-COVID means they don't have really any options. The only option they have is inflate the debt away. The only question is the pace at which they're doing it. Slowing it down the way they have with pretending like they're going to tighten for a while is hurting them, not helping them. They can do it. They could have done it for, -6%, -10% real rates for 3-4 years. They probably would have been okay. But now with this, they're extending it out, and they're probably going to have to make it much more pronounced. And I think they need very negative real rates for a compressed period of time, and then they just normalize policy, and that's it. And bondholders get screwed, low-end consumers get screwed on a real basis. Everyone gets paid everything they're owed, but it doesn't buy nearly as much. Commodities do well, and the political stuff shakes out however it shakes out, and it could be potentially nasty.
Luke, I can't thank you enough for a terrific interview, but before I let you go, please tell our listeners briefly what you do at Forest for the Trees and how they can follow your work.
Absolutely. We aggregate macroeconomic data points from a variety of publicly available sources, looking for economic bottlenecks that will stand to either benefit or hurt various sectors, and try to help our clients position properly accordingly. You can find our work at fftt-llc.com, and you can find out, I have a pretty active Twitter feed at Luke Gromen, Lukegromen.
Patrick Ceresna and I will be back as MacroVoices continues right after this. After being completely sold out of advertising space for the last couple of years, we finally have capacity to add a new advertiser. MacroVoices has a PodTrack-certified global audience of over 170,000 listeners, and each weekly episode typically gets 60,000 to 80,000 downloads. We have more than 20,000 accredited investors who have registered with us as accredited, and we estimate the total accredited investor audience as at least 40,000 accredited listeners, which we believe to be the highest number of accredited investor listeners of any podcast on the internet. We strive to accept tasteful advertising from advertisers whose product is likely to appeal to our audience. So we're looking for another investment or financial services advertiser to fill the space I'm speaking in right now. Mail-order Viagra salesmen need not apply. If your company wants to advertise on MacroVoices, please email sponsorship@macrovoices.com for more information. Now let's get right back to the show.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Luke back on the show. You know, I really, like, something we talked about on the show for years, and it really seems to come in fruition, this idea that we could have an economic slowdown at the time that we have a rising dollar, rising rates, and rising oil prices all occurring is you just literally have to throw out the intermarket playbook of the last 30 years and rethink how to build portfolios in this kind of environment. It's truly fascinating that we're in this, and it makes you have to really think about what's in store here for the next decade.
Well, Patrick, this is a topic we've been discussing on MacroVoices for years now. I remember talking to Charles Gav about this, I think it was a couple of years ago, about the fact that there's almost nobody left alive who remembers and traded through the last onset of secular inflation, which began in the late 1960s and lasted through the entire decade of the 1970s. And what I see potentially on the horizon is that we could very quickly this summer get very, very quickly forced into a deep stagflationary situation for all the reasons that Luke and I discussed. I don't think we even got to the food crisis that a lot of people are anticipating, but that's going to exacerbate things as well if that plays out. So I think as quickly as this summer, we could very quickly find ourselves in a deep stagflationary situation where the Fed's hands are tied and the stock market really is crashing, because what's happened so far has not been a crash. It's been a very orderly sell-off. So we'll see what happens. But let's get to this week's post-game chart deck. Listeners, you'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, just go to our homepage, macrovoices.com, click the red button that says Looking for the Downloads. Patrick, the chart deck is titled Summer Grind. We've only got 2 weeks left till the beginning of summer, so I guess we're jumping the gun a little bit. What's going on?
Well, yeah, obviously official summer starts a few weeks from now, but like here we are in the month of June, and the market has already started to trade sideways. So on page 2, we have the S&P 500, and listen, we've been in a pretty clear bear market style price action over since the start of the year, and we were quite oversold in the month of May, and we got a bounce. And one of the things that I'm speculating is likely to have at least above average probability of occurring is that the stock market has numerous fake outs to the upside and downside in the coming weeks. And the bigger question, was it a meaningful market low? And could there just be a new bull trend that begins from it? Or is this just a typical kind of bear market rally, typical bounces that come from an oversold condition that ultimately will be faded? And what I sort of mean by the summer grind is, while I do suspect that this is likely to be a bear market rally and fade, it's also quite possible that we're going to go right into July just chopping around with substantial overhead resistance. I marked off in the green zone some of the fib zones and previous lows where the market should start to meet some distribution and find it difficult to beat those upper levels. And if we see, let's say, over the coming 3-4 weeks into the summer, the market can't seem to beat these levels, I would become highly suspect that another breakdown move may be coming in the latter part of summer. But for now, I think it's very possible that we're just going to grind here going into July. What do you think of that thesis?
Well, Patrick, it's very consistent with my outlook. And when you said if the market can get above those key levels, I think what that really means is if there is, in fact, evidence, as a lot of people are assuming is coming, to say inflation really was transitory, it's all behind us, we're headed back down to 2%. If that all starts to play out and the Fed put is alive and well, then I think you probably get back to new all-time highs. I don't think it's going to go that way. I think we're much more likely to see a situation where we realize that inflation was not entirely transitory. There really is a secular trend underlying that temporary pulse of transitory effects, and we're probably going to see this bear market rally continue until it stops. I don't know if that's where it is now or up to the top of your shaded area there. It could be in there anywhere. And I think eventually we maybe get a setup to realize between food crisis and increasing inflation, increasing yields, that a perfect storm comes together and it really sets up a potential crash. Darius Dale told us that a crash could be coming this year. We want to try to get him scheduled on the show and get an update on that outlook as well. Let's move on to the dollar-euro cross on page 3. We've been watching that one closely for the last couple of weeks. What's your take?
Well, it's similar to the overall theme is that we're in a very oversold condition. We got a bounce, but one has to really reflect on the magnitude of the bounce so far, and it's been pretty pathetic. I mean, at this stage, you would have thought that if it was truly a meaningful turn point and a short-term low, that the velocity of the rise could have had a little more gusto behind it. We should have been able to achieve 109, 110 on the upside of a reversal. Instead, just a quick, 200-300 pip reaction off the low, and it's already struggling. This doesn't bode well for the euro, and really does, in my mind, leave the U.S. dollar rally in play. And when we go to page 4, when we really see what's moving, it's that U.S. dollar against that Japanese yen, and that took absolutely no time to clear that May high, and more importantly, even the velocity of the rise seems to have accelerated from its previous ones. And you would think after a 2,000 pip advance like this that there would have been a period where it's been priced in and would be a slowing momentum, but it doesn't seem to be slowing at all. And this to me really does put a short-term bull trend in the dollar as still the primary trend and one that has to continue to be respected.
Patrick, do you have any insight on why the strength is all in the yen and not in the euro?
Well, I think that it continues to be, the yen story anyway, continues to be all about the Bank of Japan's willingness to keep defending the yield curve control. And I think maybe the market may be testing Japan's willingness and resolve to stay to their YYC policy, or whether or not their market can make them blink. And that's pure speculation, but clearly that has been the short-term driver as they continue to leave their rates pinned, making money flow completely moving only one direction there. With that said, Eric, let's move on to page 5 where we have the crude oil chart. And really, I don't know what to say beyond last week other than that the trend remains quite bullish, quite intact. And while we have not cleared on the continuous contract, the March high, we certainly have done it on the trading contract of the July, which is the one that traders are trading right now, as well. Things like the ETF of the USO, which is what most retail traders get exposure to crude oil, has already broken to higher highs, and we continue to see oil trending so strong. The only thing that it kind of I ask in the back of my mind, the question I think about is this idea that it's becoming very consensus that oil is going higher, and it seems that almost anyone and everyone at this point has jumped onto this bandwagon. Do you think that sentiment will play a role in increasing the volatility, or do you think that's just now going to only accelerate this trend?
Well, I think it's a question of the timing of unforeseeable events. And you're absolutely right. We've come so far so fast. There's lots of room here for a $10 correction just to shake out the weak hands, for no other reason than that. If we saw the data soften and we took a little break from all of these fundamental news factors that keep popping up to push hot prices higher, then that could easily happen. The thing is, we've got so many bullish factors, and I think more still to come. We haven't really seen the mainstream come to terms with the fact that the world is out of spare capacity. And, you get a lot of excitement and attention being paid to what's going to happen at the next OPEC Plus meeting, and Biden's going to go to Saudi Arabia and meet with MBS, and, what if they reach some kind of deal in order to increase capacity, blah, 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 blah. I don't think that they can increase capacity. They've actually been pretty clear about saying that. So unless they're completely bluffing, which doesn't make sense to me because to bluff about that would undermine their own negotiating position, I think that we're in a situation where there's a lot of very bullish factors that will take us much higher. And potentially then what you get to is in August, you get to, okay, surely this has got to be the blow off top because oil prices are so high, nobody can believe it. And then what you realize is, wait a minute, Europe's whole energy problem doesn't really start until the fall. That's what exacerbates the geopolitical tension. And maybe instead of coming off of an August high, there's actually just a little reprieve into September. And by October and November, the season when Europe urgently needs Russian gas in order to heat homes in Europe, all of a sudden there's a escalation of geopolitical tension and another big move up in oil prices. That's lining up a lot of dominoes, Patrick, and we could see all kinds of things happen, including some great big grand peace treaty between now and then. But frankly, we're at a point where we're out of spare capacity, and I don't see demand coming off. If anything, Chinese demand is going to come back in to the equation, and that's going to push prices higher, just as the UAE's energy minister said this week. Let's move on to gold futures, though. Now, there's a boring market that really is boring, and you can't go to the Japanese gold in order to make the U.S. and Euro gold look any less boring. What's going on here?
Well, listen, I remain bigger picture bullish gold, but there's no denying that the price action has just been very disappointing. And what I wanted to just move and look at the chart going back at the start of the chart when June and July of 2021, you can see that the price action looks very similar. It was just starting to bounce off of a little oversold condition, and then it rolled right over for one more dip. And while it did break to lower lows back then, it didn't really last. It just kind of dipped down there and recovered. And then if you look in the January of 2022, just at the start of the year, similarly, you can see through December and January, the market just kind of grinded higher and then went to retest the lows. I kind of suspect that the summer will look a lot like this for gold, which is in the bigger picture probably does have upside, but for the short term, there's a high risk that this is just going to grind, and we may have a couple trips right back to the bottom end of these ranges, and then quick recoveries that keep it in a very tight trade range and keep it quite inactive. And I think there's an increasing chance that that's going to be the story for the summer.
Patrick, let's move on to lumber futures. They went absolutely to the moon as we saw a relocation trend from the COVID pandemic. A lot of people getting out of cities, building homes in the countryside. Boy, it looks like the price action from the pandemic is totally out of the system now. What's going on?
Right. Like, it's just worth observing that, I've had a number of people that have tried to pitch me on the idea that home builders are imminently going to be a great opportunity. And while I do understand the principle behind that thesis, and in fact, it's not wrong, it's just about whether or not the timing is right. When I look at this chart and see how lumber prices have been hammered, it's very much an indication that there is an economic slowdown underway. And higher rates and investor home buying confidence is being hurt right now, and that is being reflected on the demand for lumber. And we're now approaching levels that we've seen both in 2020 and 2021 at the bottom end of the range. Will be really interesting to see whether this is now going to be where at least some short-term support starts to be established. I think it's very premature to speculate on the upside of lumber yet, but we're now approaching some key supports. So it'll be interesting to see whether this is where the bottom end range of the lumber will end up being. But Eric, what I wanted to do is talk about nat gas on page 8. And nat gas has been very strong. Gasoline futures have been very strong. Oil's been very strong. A little bit of noise here on nat gas as there was that fire that occurred on an LNG distribution point. Was a headline the other day. But the one thing I want is really kind of reflecting on is that the story that is that Biden is talking about the fact that they will supply natural gas to Europe, and that this is the way that the world is moving forward. But when I look at this move on nat gas, and then go to page 9 where I have the natural gas term structure, what's amazing is that these higher natural gas prices are only being reflected in the 2022 contracts at the December. Once you go beyond the remainder of this year, the prices of nat gas literally fall off a cliff. And, a decade out on the term structure, we're back down to the levels where we have typically seen nat gas trade over the last, it actually really hasn't even moved over the last a year or two. And the question I sort of have in the back of my mind here, Eric, is that, well, if really the world is moving toward this idea of LNG and this movement of the North American gas over to Europe and other things like that, why has it not started to be reflected farther out on the term structure versus simply just reflecting here in the next, half a year of contracts? Do you have any ideas as to why this is playing out this way?
Well, Patrick, I think you're really onto something here, because as we have discussed on MacroVoices in the past, this move up in natural gas is not just a short-term interim spike. Now, I think that to answer your direct question, why is this not being transmitted further out on the futures curve? I think the answer is most people are assuming that President Biden's promises to supply gas to Europe are a short-term thing, and maybe they're expecting that this whole situation between Russia and Ukraine is going to be resolved by next year, and therefore the demand for U.S. natural gas to be exported to Europe is going to go away. I don't think that we're headed there at all. I think we're actually headed towards a balancing eventually where U.S. natural gas prices and European natural gas prices converge, which would be at a much higher level. Now, if that's right, as you say, it would be those longer dated futures contracts further out on the curve that would provide the most speculative opportunity to the upside. Remember, they call this contract the Widowmaker for a reason, and if you saw a U.S. recession occur, and at the same time you did not see an escalation of the geopolitical tensions that are driving the demand for U.S. gas to be exported to Europe, that could cause things to really crash quickly. And I think also that in this market, in the nat gas market, because it's so volatile, not that many traders are willing to take long-term speculative views. Like what you're talking about is, boy, look at 2 years out. I could buy that contract 2 years out, and if the situation goes the way we expect it to, which is to say that over time the U.S. will continue to export more and more of its natural gas to Europe, build more natural gas export terminals in the United States, build more ships to carry the liquefied natural gas over to Europe, and so forth. If that whole trend continues, there's a great speculative play to be made on those longer dated contracts, but not a whole lot of institutional players are willing to make a nat gas bet that far out on the curve, and I think that's the reason nobody's speculating in it.
All right. Well, I want to wrap up the chart deck by just touching on yields, but rather than looking at the 10-year yield, I wanted to look at the yield curve. Particularly, I cherry-picked the 5s, 30s here. The 210s don't look that different. But what we saw back at the start of the second quarter was a yield curve inversion, as we basically saw this go negative. And we got a bounce since then. But so far, this has been an incredibly weak bounce. And in fact, it almost feels like it's rolling over again, like if we're heading right back down. It's really interesting that when you go out into the 2 and 5 year yields, that they continue to trade very close to the levels right out to the 10 and 30 year. Like we have a very flat yield curve going out this way. And it doesn't seem like inflation, obviously inflation's being priced in to the shorter contracts in the middle of the curve, but it doesn't seem like those long-dated contracts have really exploded yet. It'll be really interesting to see whether or not this stays very close to the zero line here in the coming weeks, or whether we finally see a steepener starting to kick in.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. You can get the information on page 11 and 12 of the chart deck, or just go to bigpicturetrading.com. We're going to leave it there for this week's show. This episode of MacroVoices was made possible by Respect Energy, a leading European trader of renewable energy and a one-stop shop for all green energy investors. Patrick, tell them what's in this week's Research Roundup.
Well, this week, you're going to find the transcript for today's interview, as well as a link to the chart book that we just discussed here in the postgame, as well as a link to a number of articles that we found really interesting. So you'll find this and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account @MacroVoices for all the most recent updates and releases. You can also follow me on Twitter @Patrick Ceresna. On behalf of Eric Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.